Since the end of World War II, the US dollar has reigned supreme as the world's chief reserve currency, a status cemented by the 1944 Bretton Woods Conference, where Allied nations agreed to peg their currencies to the dollar and back it with gold at $35 per ounce. This exorbitant privilege enabled the United States to finance post-war reconstruction and later deficits. Since the end of World War II, the US dollar has reigned supreme as the world's chief reserve currency, a status cemented by the 1944 Bretton Woods Conference, where Allied nations agreed to peg their currencies to the dollar and back it with gold at $35 per ounce. This exorbitant privilege enabled the United States to finance post-war reconstruction and later deficits by issuing debt that central banks and private investors eagerly accumulated. Over time, dollar-denominated oil and commodity contracts as well as deep liquid treasury markets further entrenched its dominance. For decades, countries have amassed U.S. Treasuries as the cornerstone of their reserve management, drawn by their unparalleled liquidity, creditworthiness, and role in facilitating international trade. Yet in recent years, that trend has begun to reverse, as geopolitical tensions, tariff policies, and concerns over the U.S. weaponizing its currency have prompted central banks and sovereign wealth funds to reduce dollar holdings and diversify into gold, euros, and alternative assets. Countries historically have purchased U.S. Treasuries because they represent the world's deepest and most liquid bond market, allowing reserves to be deployed quickly without significant price impact. The United States' AAA credit rating and the dollar's status as the primary invoicing currency for oil and commodities reinforce Treasuries' safe haven appeal, especially during periods of market stress. By holding Treasuries, reserve managers could earn a modest yield while ensuring portfolio stability, as U.S. government debt has exhibited extremely low default risk over its 80-year post-war history. Following the escalation of U.S. tariffs by President Trump in 2025, new investment strategies have emerged. For example, the euro-denominated bond issuance has surged. The euro's share of global reserves rose to 20.1% at end 2024, up from 19.8% a year earlier, as European issuers tapped strong demand for non-dollar debt. Major U.S. allies, including Canada and EU member states, have likewise accelerated reserve diversification by issuing Eurobonds and boosting holdings of Japanese and Swiss sovereign debt to mitigate exposure to U.S. policy shifts. Today, news emerged that further underscores this growing shift among both U.S. allies and adversaries. April 2025 witnessed a notable retrenchment in U.S. Treasury holdings by several key foreign investors, a phenomenon driven in part by the recent spike in bond yields following tariff announcements and an enduring effort among central banks and private investors to diversify away from dollar-denominated assets. At the heart of this sell-off was Canada, whose Treasury holdings plunged by $57.8 billion in April alone, marking the most pronounced decrease among all nations tracked. Not far behind, China pared back its position by $8.2 billion, continuing a multi-year trend of incremental withdrawal. Meanwhile, a group of American allies, Norway, South Korea, France, Luxembourg, Germany, and Switzerland, collectively reduced their Treasury portfolios by a combined $14.2 billion, underscoring the breadth of the shift. Despite total foreign holdings edging down by $36.1 billion from $9,049.5 billion at the end of March to $9,013.4 billion at the end of April, the underlying causes ranged from mark-to-market losses amid volatile U.S. yields to strategic reallocations of reserve assets. The catalyst for much of April's turbulence was the administration's tariff announcement on April 2nd, which imposed a 10% minimum tariff on all imports outside Canada and Mexico and levied duties up to 30% on Chinese exports. That announcement reverberated through the global bond market, sending U.S. Treasury yields soaring, particularly at the long end of the curve. In fact, early April saw the largest weekly jump in yields since 2001. As bond yields climbed, the inverse relationship with prices meant significant mark-to-market losses for existing holders. Taking Canada as a case study, despite face value purchases amounting to $9.20 billion, its highest monthly investment since November 2023, the country still recorded a net $57.8 billion drop in holdings due to these valuation markdowns. This pattern of paradoxical buying amid falling valuations also played out in financial centers like Luxembourg and Switzerland, where custodial reallocations and liquidity needs triggered tactical sales even as investors aimed to capitalize on attractive new-issue yields. Against this backdrop of tariff-induced yield volatility, country-specific rationales emerged that helped explain why Canada, China, and various European allies chose this moment to rebalance their portfolios. In Canada's case, the government moved swiftly to diversify its reserve base. In March, Ottawa issued a 5-year global bond worth $3.5 billion, attracting an order book of nearly $14 billion and earmarking proceeds for high-quality assets, including euro-denominated and domestic securities. This issuance highlighted Canada's intent to broaden its reserve holdings beyond U.S. Treasuries, even as domestic investors continued to snap up U.S. bonds at face value. Similarly, Statistics Canada data showed that Canadian pension funds and insurance companies increased their U.S. Treasury purchases precisely because the higher yields offered compelling returns on new investments, even if the value of existing holdings was under pressure. For China, the April reduction was part of a much longer arc of diversification that reflects geopolitical considerations and an evolving view of reserve risk. Beijing's central bank continued its steady march toward gold and non-dollar assets, acquiring an additional 70,000 troy ounces of gold in April, its sixth straight month of net purchases, and bolstering official reserves to roughly 2,292 tons. This accumulation brings gold to about 6.7% of China's nearly $3.2 trillion in foreign exchange reserves, up from just 4% 2 years earlier. At the same time, China has expanded its euro-denominated bond holdings and increased allocations to onshore yuan assets. These moves are designed to insulate the country's vast reserves from the ramifications of tariff disputes or potential sanctions, and they underscore a deliberate strategy to hedge against dollar volatility. European allies also seized the opportunity offered by higher yields and a stronger euro to recalibrate their portfolios. Norway's sovereign wealth fund, the government pension fund Global, modestly shifted allocations toward European and emerging market bonds, while maintaining its core equity exposures. South Korea's National Pension Service, with a mandate to secure long-term returns for its beneficiaries, similarly raised allocations to European government and corporate debt as Eurozone yields approached parity with U.S. levels. France, Germany, and Luxembourg, acting in concert through shared EU fiscal initiatives, deepened domestic market liquidity, making euro-denominated debt more attractive to both official and private investors. Even Switzerland, known for the stability of its financial system, saw small-scale downsizing in its U.S. Treasury holdings as part of regular rebalancing activities tied to liquidity and regulatory requirements. These April trends reflect broader long-term shifts in global reserve management. Central banks worldwide have signaled an unprecedented intention to boost gold allocations over the coming decade. Nearly 40% plan to raise their gold holdings, the highest share since 2019, and continue seeking alternatives to U.S. Treasuries amid questions about the trajectory of U.S. fiscal and trade policy. Meanwhile, the euro has benefited from Europe's fiscal expansion and a relatively accommodative European central bank, with the single currency appreciating roughly 12% against the dollar in the first half of 2025. Barclays data reveal that central banks and sovereign wealth funds accounted for 20% of Eurozone syndicated bond purchases this year, compared with just 8% in 2021, signaling a clear shift toward euro-denominated assets. Additionally, emerging market and domestic assets are capturing greater share of reserve allocations, as countries like Canada and China issue their own global bonds, or develop onshore capital markets to provide new outlets for official and private capital. In sum, April 2025's $36 billion net decline in foreign holdings of U.S. Treasury securities was less a story of outright coordinated dumping than one of reflexive mark-to-market adjustments combined with strategic portfolio diversification. Canada's dramatic $57.8 billion markdown China's ongoing pivot to gold and non-dollar reserves, and the measured repositioning by European allies collectively illustrate a more nuanced response to U.S. tariff policy and yield dynamics. As nations continue to broaden their reserve horizons, investing in gold, Eurozone debt, and domestic instruments, the long-standing dominance of U.S. Treasuries faces its most significant test in decades. Going forward, the interplay between U.S. trade policy, geopolitical risk, and central bank reserve mandates will shape how the world allocates its capital across the key assets of global finance. Thank you for watching. As an independent channel, we don't have corporate backing. We rely on your support to keep going. If you found this video valuable, please give it a thumbs up and leave a comment below. It really helps more people find our work. Thank you so much for being part of our community. Check out the next video on your screen. We picked it just for you.